Welcome back, everyone, to your stock market weekly update. Sorry for being a little late this week. Had some stuff come up and had to post this video a little late. But in this week's episode, earnings season is winding down, and so far it's looking like an earnings recession with 3 quarters in a row expected to be negative. So I'll share my thoughts on what that means for the broader economy and the stock market. Plus, we also received comments this week from Jerome Powell on the economy and inflation. We also had President Biden give his State of the Union address, and the stock market, just kind of in general, fell pretty hard this week. So I'll share my thoughts on all of that. And as always, I'll also run through the biggest gainers and losers for the week as well, let you know if anything catches my eye. So hope you guys enjoy it. Chapters are in the time bar in case you need them, but let's jump straight into it. Alright, and starting first here with the markets, like I said, it was a negative week overall with the S&P 500 falling over 1% after having a great start to the year and still up over 6% year to date, but the Nasdaq fell even more at almost a 2.5% drop, although it is also up about 12% year to date, and a lot of people feel that the market was getting overextended to start the year considering that the economic news is still looking pretty horrible everywhere. So a small correction here definitely makes a lot more sense, even if it was just a small drop. But from the top, this now leaves the S&P only down about 15%, which I personally feel it's still a little too high. I think a few more percentage points down would be more reasonable. But we do at least have the tech-heavy Nasdaq well into a bear market, as it is still down close to 30% from the top, which I do agree with a lot more. And I actually think a lot of the stocks in the tech sector are starting to look pretty attractive from a long-term perspective. But turning over to market news, there wasn't really anything too crazy this week, although we did receive some comments from both the Fed Chairman Jerome Powell as well as the President of the United States Joe Biden in his State of the Union address. But in my opinion, both men said exactly what I expected them to say, so nothing was a big surprise to me personally. Jerome Powell spoke fairly calm about the economy, which initially sent stocks higher, but that later changed when he started talking about inflation and mentioned that they will continue to raise interest rates as long as jobs continue to climb and inflation remains high, which did send stocks lower. He essentially said that they will do everything they need to do to cool down the economy and help bring that hot inflation down. Also saying that they may need to make some unpopular decisions in the process, which the market did not like that wording. This is despite also having already raised interest rates again the week prior, which came off of 7 rate hikes last year, so a lot of interest rate hikes. But again, this is exactly what I expected him to say. We all know that inflation has been coming down significantly in recent months, as you can see on this chart here, falling from over 9% down to 6.5% today. But even here, we are still well above the Fed's target rate of 2%, and we are still sitting right near a 4-decade high, which is completely unsustainable. So the higher interest rates will continue to come until things get back to normal. And my opinion is that the market will continue to hate that, and therefore I do expect it to remain volatile throughout this year. With that in mind though, I also feel that Joe Biden said exactly what I expected him to say, as he called for more taxes on billionaires, including unrealized gains, a quadrupling of stock buyback taxes for corporations from 1% up to 4%, and an increase to the debt ceiling, which are all things that Democrats usually push for, so none of that surprised me. We also have a split Congress with Republicans controlling the House right now, so I doubt many of these policies will even go through. I mean, the tax on unrealized gains is not a very popular tax in general, since it taxes stock gains even if the person never sold the stock, although I believe that can later be written off anyway, so I feel like it just kind of complicates the tax code without really solving anything. But I don't know, I'm pretty impartial on it. It's for rich people. As long as they don't implement that on smaller investors like myself, I don't really care about it. And even when looking at trying to raise the debt ceiling, that's also going to need a lot of negotiation and compromise with Republicans that want to make cuts to the budget, so you're just going to have some give and take there as well. It's going to not too big of a deal. The only thing that really caught my attention from all of this was the tax on stock buybacks, because that can actually hurt EPS numbers and valuations. But even their sources say that not even Democrats in Congress are in favor of it. So in the end, I'm not really sure any of these policy proposals will have much impact on the stock market, if at all. What I do think is actually much more important to pay attention to, though, is the fact that our current earnings season is projected to finish in the red at negative almost 5% growth for the fourth quarter of last year, which is something that FactSet expects to continue. And look, normally this wouldn't be a huge deal because earnings can swing wildly from quarter to quarter, sometimes by like 20% or more. But the thing is that there are several concerning indicators that are popping up, which makes this earnings season in particular look much more worrisome. Now, one of the reasons why nobody is paying attention to it is because earnings are actually surprising to the upside. We've now had about 70% of S&P 500 companies report, and about 70% of them have actually beat on profits, with about 63% also beating on sales. Excuse me. However, not only were those estimates already extremely low to begin with, but we've also now lowered them even further from a 3.3% decline in profits at the start of the year expected, now revised down to almost a 5% drop, which will also be the first time that we see a decline since the third quarter of 2020, where the profits fell by about the same amount. And as you can see on this chart, we actually had GDP fall by about 2% year over year in that quarter. So there was definitely a correlation there with the broader economy. And of course, right around that time was also when we had one of our sharpest and deepest recessions in history. Now, since then, GDP and S&P 500 earnings have recovered greatly because of all the stimulus, but we've now seen stimulus dry up, leaving us with record high inflation and interest rates, which is causing GDP and earnings to start falling once again. And the scary thing is that our negative earnings growth is expected to continue falling for some time. So far, only 13 S&P companies have issued positive guidance for the next quarter, while close to 60 have said that they expect earnings to decline. And when looking at overall projections, again, analysts expect about a 5% decline for last quarter, then they expect another 5.1% decline this quarter, and as if that wasn't bad enough, they expect another decline of over 3% in the second quarter as well. So that's 3 quarters in a row of negative profit growth, which is a pretty big deal. Now, the good news, however, is that it is at least expected to quickly turn around after that, with a 3.4% gain in the third quarter and over a 10% climb in the fourth quarter, which actually ends the year with projections of about 2.5% positive EPS and revenue growth for the full 2023 year. And so that's why I continue to say that a recession is not off the table, and it can definitely still happen, but I actually think it will be in the first half of the year rather than the second half. And I might be wrong about that. There's a lot of people out there that are predicting a recession will actually happen later on. But when I look at the economy right now, I just feel like things are looking so weak already that I feel we're going to have a little bit of a bounce back towards the second half of the year. And don't forget, right now we're raising interest rates like crazy. And I know that is kind of painful right now, and you may not like those rising interest rates. But if the economy goes into a recession and the stock market falls, you might actually be thankful for those rising interest rates, because the Fed will actually have ammunition this time to get us out of that a lot quicker than I think people realize. So in my opinion, I feel like if we do have a recession, it'll be relatively short-lived, and I think inflation is going to continue coming down, supply chains being restored. I think the Fed will be able to lower interest rates if we go into a deep dive here, and that'll actually get the economy to bounce back a lot quicker than people think, and I think the stock market will soar off of lowering interest rates. So I'm not too worried about what's going on here. I do expect continued volatility throughout this year, but as a long-term investor, I welcome that volatility, and so should you if you're also a long-term investor, because that just means you get to pick up your favorite stocks at better prices through the volatility. So right now, if I see a stock that I like at a price that is reasonable, I'm picking it up. I'm not trying to time this crazy market that we're going through right now. If I like a stock, I'll pick it up and I'll invest in it long-term. But if that stock is trading at a price that I think is too expensive and I'm not very comfortable with it, then I'll wait. I'm not going to rush into anything in this kind of market. We might have some more volatility. I might be able to get a much better entry point on that stock. So it's no big deal. But overall, as a long-term investor, none of this really worries me too much. But that's just my opinion. We all have our own opinions and our own thoughts. Anyway, with that said, guys, let's finish up the video now with the biggest gainers and losers for the week, and I'll let you know if anything caught my eye there as well. Okay, and starting first here with the gainers, really wasn't anything too exciting this week since most of the market was of course falling, but we did actually see big oil and gas companies surge, with BP climbing over 15%, Phillips 66 over 8%, Marathon, Occidental, and Valero all climbing about 7%, ExxonMobil above 6%, and the Brazilian Petróleo Company, and then also Royal Dutch Shell also climbing about the same amount as well. And this was due to a combination of things. A big part of it was stronger than expected earnings from most of them, with several posting record profits and an increase to both their dividends as well as their stock buybacks, really rewarding shareholders on both fronts. But on top of that, there was also a rise in oil prices this week from Russia, one of the biggest oil producers in the world, announcing that they will cut output by 500,000 barrels per day next month as a reaction to the West imposing sanctions and bans to certain oil products from the country. The cuts should make oil prices climb even further though, thus increasing the profit of these companies. Now, I've never been super interested in buying pure play oil stocks myself, as I just find the whole sector to be like too volatile really for my taste. And right now, many of these stocks are also trading near record highs. Here's a 10-year chart of BP. Here's a chart for Shell. This one is of ExxonMobil, and then this one is of Chevron. So I just don't feel very comfortable investing in these long term at today's high prices, especially since I think the market is shifting to renewables in the future. But I can definitely understand why others like to invest in them, as many carry some pretty attractive dividend yields, usually above 3%. But even then, I actually think there's better dividends elsewhere, like in biotechs, for example. Anyway, moving on to the biggest losers, just a few stocks that really caught my eye this week. Of course, the ride-hailing speculative stock Lyft was the biggest loser of all, falling a monstrous 41% this week after the company was expected to report a slight profit, but they actually came out with a huge loss, while also lowering guidance for the next quarter as well, which led to a number of downgrades as analysts start to wonder if rival Uber is really destroying them in the mobile taxi race. See, Lyft reported over a $500 million net loss, which was more than double what they lost the year prior, and while they guided for 11% revenue growth next quarter, it was still well short of analyst estimates. And just as important, this comes only days after rival Uber reported a beat on both the top and bottom line. So after downgrading the stock, the head analyst from Wedbush called Lyft's report and earnings call, a conference call, a debacle for the ages, and said that they face an Everest-like uphill climb to profitability, which is in stark contrast to big brother Uber. I gotta say, at a price to sales ratio below 1, Lyft stock does start to look pretty interesting, but with huge losses every single year, it's still a tough pill to swallow. I personally just invest in Tesla and Baidu, who both have big plans for the future with robotaxis, which I feel is enough exposure for me. Okay, we're running out of time here, but just a few more spec stocks that fell this week after being dragged down by the market. We had the cryptocurrency exchange Coinbase, the online furniture retailer Wayfair, and the exercise bike company Peloton, all falling around 20% or more. They've also been announcing layoffs. They had earnings a while back that were pretty bad. One spec stock that I actually own myself, though, is Palantir, who also fell over 10%. And I'm hoping they fall more because I really want to start buying more of that stock. But then we also had the almighty Google actually make it pretty high up on this list as well, falling about 10% this week after they announced their chatbot rival to Microsoft called Bard, who, after getting a question wrong during the presentation, analysts became worried that Google was forced to market with a chatbot that is not quite ready for prime time, and thus they're worried that Microsoft may actually steal some market share from their search and browser markets after implementing ChatGPT into their own services. I'm not personally worried about it though, and to be honest, I actually own stock in both companies anyway, But Google has been investing in AI for many, many years now, and I think that their services will be just as capable over the long term. So I'm not worried about what Google is doing with AI. From the top though, Google stock is now down almost 40% in one of the biggest crashes I've seen, and I personally think that it's a screaming buy at these levels. If you want to learn more about the whole chat GPT race though, I just put out a video that explains a lot of it. And finally, I'll just mention that a couple Chinese stocks also fell this week because of all the issues that China is facing with their economy, really, sending the e-commerce giant JD.com as well as the EV startup NIO both falling close to 10%. And I actually hope NIO falls more because I really want to buy some more shares of that one myself too. But anyway, that'll do it for this week's update. I hope you enjoyed it. Let me know your thoughts down below on anything we discussed. Hope you all have a great next week as well. Thank you for stopping by. I'll catch you in the next video. Take care, my friends. Bye-bye.